Hey, what's up, guys? All right, so today we're going to be going over understanding whether or not we have like a great real estate investment deal here in the state of New Jersey. I'm going to go ahead and just make a quick statement that there's no such thing as a risky project. There's only such a thing as very risky assumptions. All right, so if you like aren't good with your assumptions, aren't good with your analysis, then the deal is going to be not good because of that. Now, who am I and why am I trying to let you guys know these things? Well, my name's Jason. I've been in real estate for about 8 years now. I've been a real estate agent. I've done both the real estate transaction side and the real estate finance side. I've been a mortgage processor. I've been a loan review analyst for a portfolio of loans for a bank in New York. I've done investment properties, like I've have investment properties. I've done investment deals, and I've also been in contracting for a large part of my life when I was younger. This video is going to be about the analysis part. Okay, so because that's one of my strongest suit, I'm able to analyze specific like deals, whether or not they are viable for us to be able to invest in. And the first thing that I want to go over is the first factor. It's going to be ARV. Now, what is ARV? ARV is just basically what your comparable homes are selling for currently in the market. Okay. And why is ARV important? I know you guys have gone through this multiple times with different people, but ARV is important because without a great understand, like a good ARV, solid ARV, you're not going to know how much your like offer should be, right? Because your offer is here, and then based on your offer, you're going to have to add your rehab costs, and then you're going to have to understand what your margin is going to be for how much you want to sell it for. Your margins collapse too with a very bad ARV. So, like, let's say you're thinking that your margins are this big, but they're actually like this big, right? So, basically nothing. And your exit strategy is also determinant whether or not you have a good ARV. That's why when we go over here, we have our homes listed for sale, our recently home sold, but we also have rental comparables over here. So I'm going to go over that bit first. What I want to talk to you guys is how you know it, like some signals to know whether or not your ARV is good or bad. One of the best signals is if your ARV right here is within, like your recently home sold is within 90 to 180 days, right? You want to be able to not have, oh, you don't want to go out of the season to be able to know how much the properties have sold just recently, right? You want to have that like very close to the time frame of when you're buying the house, so in that way you know that it's going to stay around that price and not fluctuate too much. Because we're buying something from based on prices from last year, it's definitely not going to equate to what the prices are currently this year. You also don't want to have like one property that is crazy, like high and expensive. That's why over here we have different form, like different property columns, right? Each column is for one specific property. And if one of the properties, let's say one, is overpriced, we just take that property out because, again, you guys know you take the most expensive property on your comps list and the least expensive property on your comps list, so you take them out. The whole point is just basically saying you want to get the averages of the whole thing, right? And if one of them is more expensive, this is why we acquire multiple types of properties. We write it down. All right. The other thing is that we want to know whether or not we're moving from different areas of the town. So, like, let's say you have one comp over on this side of the town, another one on the other side of the town. Well, considering we're going to have multiple comps written down, we're going to have to take those out as well because we want to be able to compare at the immediate area of where we're looking at. All right. And then the final thing is if your ARV has a margin of 30% or less, then that's a risky thing. You don't want to be able to buy after let's say you find out how much your rehab amount is going to be, and you figure out how much you're willing to
you find out how much your rehab amount is going to be, and then you find out your ARV. Well, you just take 30% of the ARV, and then you subtract your rehab amount, and then you're going to be able to get your offer price. So that's just one of the ways that we're going to be able to do it. This right here is one of the most professional ways that I've seen people in the industry be able to organize their comparables. So
It's one of the ways that you guys can use it, and it's a very important way to be able to understand whether or not you have a good risk factor when it comes to ARV. Another risk factor is going to be for the rehab risks and scope of work. It's not about like the amount of money that you're going to be spending on the project. It's just basically about the predictability of how much you're going to be spending, whether or not you went through the proper channels to verify you did your due diligence and called the contractors, got the estimates, and done the full work of being able to do this, right? The reason why being able to have like a great understanding of scope of work when it comes to doing real estate transaction, real estate investing, is you don't want to go over budget when it comes to doing these things, because let's say you're just guesstimating on some of these things. Most of the times you run into like an emergency and you go over budget, and that really eats into your margins, and you don't want to have to do that. Holding costs is also a very important thing that if you don't do this correctly, it's going to affect your holding costs, and then again, that's going to affect your margins. And if you have less margins, you're going to have to be forced to sell at like a very discounted price, or um, or at a loss, basically. All right. So here are some like signals of rehab risk. Right. If you have like foundational problems, I technically I wouldn't really like get into any of that type of stuff. If you have, well, because you foundational problems are very very fucking expensive. Sorry, excuse my language, but they're very very expensive. And if you have like things like roofing or electricity or plumbing or HVAC, those are things that you can do if you have the skill set to be able to do them. But if you don't, those are also red flags that you're going to want to avoid. So very big like property rehab expenses are going to be those things, right? Um, but another thing that you want to kind of like look into that people don't really mention is the city going to allow you guys to be able to do what you want to be able to do, right? So let me take you
you
guys.
guys over here, this right here is a Gantt chart, which basically breaks down by month what you're going to be spending. So what you're going to do is you're going to list out all of the different steps in your rehab right here, and then you're going to list out at what point are you going to fork over the money for each part of those things. And if you guys study things like a Gantt chart,
That's basically what this is. It's a Gantt chart for your construction project. All right. So the last and the third factor is actually going to be like exit strategies, and I want to take you guys a little bit through the different types of exit strategies. We only have about two different types of exit strategies. I mean, categories, two different categories for exit strategies. We have the capital gains category and the recurring income type of category. Okay. In other words, we're going to have the selling or the refinance type of categories. When I say refinance, I'll tell you guys what it means. So for selling, we have things like wholesaling. If you find like a house that's like pretty shitty, or like a house at a very very deep discount, you could sell that to an investor. You're going to be able to get a form of payment, finder's fee for that type of thing. You're also going to be selling if you have a house. Let's say you have that house and then you put it up in the retail market. Let's say it qualifies for the retail market. Most of the time, a very discounted house doesn't qualify, but let's say it does. It's going to be another form of sale, because the retail market is able to pay a lot more than what an investor would be able to pay for that type of property. Okay. And the last category that I'm going to go over is just a value add category. Let's say you find like a pretty shitty property, you clean it up, you do the things right, and you sell it off at the retail market. That's another form of selling, because it's another strategy of selling for the capital gains. All right. Refinance. When you have refinance type of exit strategies, you go into things like BRRRR, right? You guys know buy, rehab, refinance, resell, or something like that, right? So you want to be able to go and understand what the refinance part of the exit strategy is just basically for like recurring income. House hacking falls into this, and portfolio yields also fall into this. So so yeah, you want to be able to understand whether or not you're going to be doing any of these types of things. Why it matters? Well, the reason why it matters is because different markets shift from time to time, and you want to be able to know like whether or not what you're going to do. Let's say if the transaction takes too long, and you change into a different season, you want to hold the property for that long. You want to be able to shift it up to like a rental type of situation. The days on the market influence like your holding costs. Lenders also tighten up like their requirements for the types of things that they require for a property to do. So you want to have a clear understanding of what exit strategy you're going to be taking before you do any of the work and any of the money capital investment, right? You also want to have like a backup exit strategy just in case your first exit strategy doesn't work. You want to have like a backup just in case, because you don't want to lose any money when it comes to doing real estate transactions. All right. Some signals that your exit strategy just might go bad is if you have no backup, right? The refinance is impossible because DSCR is not possible. DSCR stands for debt service coverage ratio. Okay. The market inventory is less than 3 months. If you guys want me to go over market inventory, I'll go over it in another video, but it's just basically understanding whether or not you have 3 months supply in the current market that you're in. It'll show you whether or not you're in a seller's market or a buyer's market. It's just basically directional understanding of how the market is going to be shifting, right? If there's any appraisal gaps, or if your DSCR that you're currently managing for is less than 1.2, then that just basically means that you're spending, your earnings is going to be less than 120% of your total expenses, basically, right? So like, let's say your expenses are $20. I'm sorry. Let's say your expenses are $100, right? Your earnings should be 120. Yeah, that's just basically it. If it's anything less, then you're basically in trouble. All right, so that's the triangle. The ARV, reliability, rehab predictability, and exit strategy safety. That's kind of what I want to go over with you guys. All right, if you guys want to like find out anything more about these types of topics, I definitely encourage you guys to place in the comments down below, what type of topics you want me to go into. I'd be more than happy to go into depth in any single one of these topics. Also, if you want the templates, the different structures that I used here in this video, you can just go to my website. It's going to be right there at the bottom. I don't mind giving that out to you guys for free, 100%, anything to help you guys out. But other than that, I want to thank you guys so much for watching the video. And yeah, please let me know what else you guys want me to go into. These things are important, man, because I've seen people go into different types of markets, and a lot of the times they want to go in for the thing that looks pretty and in the market where everybody's at, right? And they don't have that much money. And one of my most humbling and empathetic type of recommendations for those people is you should go where your money is going to be able to make a bigger difference, right? And if that means that you have to go out of the city to be able to get that done, no problem. That's what you should do, right? But if you want to be closer to the city, just know that the amount of money that you're going to have to be spending is going to be a lot more than what you would be spending if you were further away from the city. Other than that, I hope you guys enjoyed it. Please, again, let me know, and I'll see you guys on the next video. Deuces.